SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures and founder of SMB Investor Network. Today I'm joined by Jacob Hall of Cando Capital. Jacob, like us, is an investor in self-funded search, independent sponsor deals, and all things small business. So, Jacob, thanks for joining us.
Hey, thanks for having me, Sean. I'm excited to be here.
Why don't you give us an overview of yourself, how you got into this space, and tell us a little more about Cando Capital?
Sure, be happy to. Probably something that's a little bit unique about myself is I actually come from more of an operations background than a private equity or investment banking piece. So to be in running a fund in the space, it's kind of a little bit different background than most people. I worked in multiple corporate roles for large Fortune 500 and all the way up to Fortune 10 companies, and then also have gone in and ran small businesses before as an operator. So as a COO for a small business, very similar to the size of what a lot of searchers are out there looking to acquire. So I had a good mix of experience in the operations side, and obviously that starts to cross over to the finance piece as well. Originally started to look at investments in companies to go out there and purchase for myself. And then as I started to get into this space, I eventually moved more into a capital allocator role and investing money, both my own and investors, originally on a deal by deal basis, and then moved into a fund structure, which we invest out of now. Condo Capital, we're based out of Houston, Texas, but we invest anywhere in the US, and we're pretty agnostic as far as some of the businesses that we invest in. So we happy to dive into any of those pieces as well. But typically, as you mentioned in your intro, self-funded search, a little bit of independent sponsor deals as well, and pretty open as far as the type of opportunities that we consider.
Yeah, it's a good way to be because I think, what we're seeing more and more is there's so many interesting niches, right? And if you have an industry focus as a capital allocator, that really limits the deal flow you can have access to. I mean, the asset class itself is not the biggest anyway, so you can't limit yourself too much with some kind of industry thesis, but you can kind of define what everyone likes to call your buy box. So maybe tell us a little more about your buy box and how it's evolved as you've started to invest in more of these deals.
Yeah, absolutely. I'd say we probably have a pretty broad area that we'll consider. So there, it's a little bit easier to define some of the things that we don't do, and that's usually in any type of a business that's really highly discretionary. And I think that's kind of a common theme from a lot of people, both in the search fund world and also on the investor space. We tend to look for businesses that are enduring and that have a strong track record of profitability. In our case, that also happens to be a lot of the more boring businesses that you'll hear people talk about. So we look at services businesses, but also light industrials, manufacturing, anything that's kind of keeping the country running are the types of businesses that we really like. And to your point, a lot of the best, most exciting opportunities that we've had are in more niche categories, things that we wouldn't have necessarily set out to chase after deals in that space, but that were brought to us or that we discovered opportunities in and have really turned out to be some of the better plays that we've found out there in the marketplace. But as far as more broadly, primarily B2B investors, but we do some business to government as well. And then we'll do some consumer facing stuff if it's in that more non discretionary category. So usually that relies upon service and things like that. Enterprise value, we'll look as small as maybe 3 million, 2 million in enterprise value is probably the practical lower limit. Then on the larger end, most of the time EVs around 25, 30 million is about the size where we tend to stop investing above that just because our check size becomes somewhat not as meaningful in the grand scheme of things whenever you get those deals north of, say, 30 or more. And then as far as the entrepreneurs that we're looking for people that have a solid track record, probably a combination of work experience and education. Doesn't necessarily have to be in the field specifically that they're buying, but definitely some experience, leadership with teams and things like that are going to put them well positioned. We don't want to go into an investment with somebody if they're not really primed for success, and we want that for them as well as for us. And so that's a big piece is who the buyer is, what their background is. And then obviously the last piece is kind of focusing on all of the specifics of that business. What characteristics make it an enticing opportunity? What are the financials that drive it? What things might look like for us as an investor? And then also what type of governance and other things are going to be in place there to make sure that all of us are successful and kind of rowing in the same direction.
That's great. Yeah. So common themes we hear a lot, right? No discretionary kind of sensitivity, kind of implicitly in a similar vein, not a lot of cyclicality. You talk about buyers that have that leadership level experience that understand how to manage both a revenue growth, cost center is ultimately a profit center. And then lastly, kind of the right terms, the right deal structure, all that stuff. I think that's kind of the almost like the four key pieces to all these deals. You can throw the industry and the local market in there as well, or include that in the company, however you want to think about it. But one thing that might be really helpful for folks is like if you unpack why those themes are frequently talked about in this space, I think that could be really helpful. And I can kind of give my 2 cents. Like the discretionary cyclicality stuff, you can't have a business where revenue or earnings are swinging all over the place when you're putting a lot of leverage on it, right? You need to be confident that you're going to see a consistent earnings profile. So those credit metrics, your fixed charge coverage, that stuff isn't going to swing into the red and you're going to make your debt payments. But some of the stuff about the operator, why is it so important to have someone that has been through kind of the leadership role and seen how to run P&L centers?
I think, as you know, Sean, being in a small business is significantly different than being inside of a large enterprise. And so finding people that have a good understanding of what that's going to entail is pretty important in order for the deal to be successful. So I think that that's probably a big leading piece of what we're looking for whenever we're going into the deal. They're highly levered. Small businesses, just kind of by their nature as well, are a little bit more fragile. We're not talking about a mid-market enterprise here that's got a ton of mass or kind of inertia that's going for it. Small businesses are much more dependent upon the people that are inside of them. And so making sure that both from the acquirer side and also what's existing there in the organization is a good fit is really important for us, because it is an asset class where the people make a very, very important difference in the success or the performance or lack thereof of the investment and the opportunity.
Yeah, that's for sure. So, what would be some red flags when you're looking through kind of the company that would set the alarms off that this might be a little too discretionary or cyclical?
Yeah, I think that if I can put them all under a really big umbrella and maybe under a couple umbrellas, we're definitely looking for revenue quality, and we're trying to figure out how does this business make its money and understand the components to how that business operates. If you start to run into situations where you've got a ton of customer concentration, or if you have even a ton of supplier concentration, any of those things that might make the business a little less stable are going to be points of consideration. It's not necessarily a deal that we won't do, but we'll want to understand what are the mitigants, how are we going to deal with those potential challenges. And so each one of those things, whenever we're looking at the revenue side, the supplier side, employee side, kind of all the things that you're going to go through in diligence, those are all areas where we're looking for things that might potentially need to be addressed. Some of them might make the deal completely untenable, or might make it to where we really have to reconfigure the transaction in a way to provide protection for all the parties that are involved. And in other deals, it's just a matter of having the transition plan really clear in the mind about how you're going to overcome some of those challenges. But I would say definitely focusing on the nuts and bolts of the business, understanding how they make their money. My background is actually originally in mechanical engineering, so that's probably one of the reasons we gravitate towards a lot of physical businesses and things that have actual products or components that's behind them. We want to be able to get behind the business, understand how it works, and look at the challenges there. And it's as simple as I'm kind of looking at a SWOT analysis, understanding the suppliers, the customers, what threats may be on the horizon, whether they're technology related or something in the competitive environment. Those are all things that we're looking at for that specific business. And also, of course, trying to understand how that operator's experience ties into the opportunity as well.
Yeah, kind of drilling in on revenue quality and just how the business makes its money is so key. I once earlier in my career, we were presenting as a slide that had a bunch of potential M&A targets on it, and a gentleman who was a second generation single family office in the Illinois area said, there were all these metrics on the companies, right? They're multiples and they're this and they're that. And he said, just tell me in one sentence for each company, how do they make their money? What's their business model, right? And when you take it back to that level of simplicity, and of course you drill in further from there into the customer concentration, how are they actually structuring their relationships with contracts, but you take it back to kind of that first principles look and build it out from there. It's just a fundamental piece of understanding revenue quality and then eventually, competitive advantages, all that stuff. So I think that's a great first kind of umbrella to look at things under. If you talk about some other red flags, maybe related to the buyer or kind of the searcher or sponsor's experience, what kind of is the first one that comes to mind?
Yeah, I would say that we're trying to look for the maturity of the sponsor and their understanding of what their life is going to look like post close in the transaction, and what it looks like in the role that they're going to be playing in that company. And so, if maybe to give you some specifics, an example of that, if somebody's worked in a very professional white collar environment their entire career, and they're going to drop down and try and run a very blue collar business that might have 10 or 15 employees, that by its nature means that they're going to be somewhat exposed to the front lines, and is going to probably be a big departure from what their career has been up until that point. Now, that doesn't mean that they won't necessarily be successful or that that isn't a good fit, but we'll want to understand that tie. And if there's not a tie, that's a huge red flag for us. If there's no, if it's just strictly, hey, this fits our transaction size and therefore we want to go after it, that's really not a great reason to go after a business, in our opinion, because there are a lot of businesses that might meet some criteria, as far as revenue and gross profit and things like that. But that doesn't mean that that operator that's looking at that business is necessarily a great fit for that particular opportunity. So you can have great company, great operator, and it still not necessarily be a fit or a match that's great. And so we want to see some alignment in both of those. Some more red flags that we would see, which I kind of touched on a little bit earlier. If they don't have any type of P&L experience or managing the bottom line, it's going to be a pretty tough transition for them to make, to do that their first time as the ultimate person in charge. Same thing with leading teams. They don't necessarily have had to lead hundreds of people, but if you haven't had some experience in that leadership role, being able to get performance out of employees, hold them accountable, understand what it's like to guide the direction of an organization, those are all things that, depending on the specifics of the opportunity, might kind of pop up as, if not red flags, at least yellow flags, and want to understand how those issues will be dealt with, and why they will or will not be a problem in the deal going forward.
That's great. So I like the concept of red or a yellow flag. So a lot of times, in our checklist, the way we'll get to yellow, for example, say there's 25% customer concentration, or maybe the top 5 customers account for 50 to 60% of revenue, right? That's pretty significant. A loss of 1 or 2 of those customers could be pretty material to the company's top line. But perhaps we can get it to yellow because there's certain deal structuring elements in there that make it a little less risky. So what are some of the ways that you guys look to mitigate that first revenue quality kind of umbrella that you mentioned, specifically probably starting with customer concentration, for example?
Yeah, I think that it's important to be able to mitigate that in the deal structure itself. So a lot of times that's something that we're looking for from square one, as we're trying to figure out what the alignment is between the seller, the buyer, ourselves post close, and that the transaction is structured in such a way to achieve that outcome. Because we really want everybody from win to win in a transaction that we're involved in. We don't want it to be kind of a winner take all. One party wins and the other parties feel pretty bad about the deal. And so I would say that structuring the transaction in such a way to overcome those red flags might look like forgivability in part of the seller note, or some key components of compensation that might be tied to that. If you're not in an SBA deal, there's probably a lot of opportunities for earnouts, or other, maybe some rollover and other creative measures that you can do in order to make sure that what we think will happen post close will happen. One common mistake that I see from a lot of first-time buyers, or people that it's their first time transacting in the space, they tend to discount some of the risks or dangers around things like customer concentration, because they haven't seen enough of those deals go through to really recognize that it is an existential threat. It's pretty easy in their mind to dismiss, like, oh, I think we're going to keep this customer, it's not going to be an issue. But for people that have been involved in multiple transactions and seen what can happen post close and how easy it is to have one of those turn into an issue, it's all going to work out is not really a strategy that we probably accept in the investor world. So we want to understand, how do we deal with that? And usually it's going to be some combination of structure or tie in from that seller post close, so that we can get really comfortable around that customer that might make up a significant portion of revenue, kind of staying along for the ride, at least for a certain period of time through the transition.
Yeah, the forgivable seller note has become such a strong tool for self-funded searchers using SBA loans to finance their deal. Very similar in principle to an earnout. And I think it's pretty much the strongest way we're aware of, at least, to kind of mitigate some of that potential loss, right, due to the customer churn post close, right? The compensation item is an interesting one to bring up. We've seen, of course, it's commonly kind of shared in investment memos and things like that, that there's going to be a transition agreement or a consulting agreement for a certain period of time. But one structure we've liked is commission plans that in some cases can outweigh or significantly increase the total consideration that a seller might get. Those concession schemes can be tied to commission schemes, sorry, can be tied to both upsell, they can be tied to retention to some degree, or kind of new business, right? So what other kind of employment structures have you seen that kind of do the same thing?
I think that's a great example of getting creative in the deal structure. Whenever you're not bound by rollover limitations like you are with some of the SBA deals at this point, that is another pretty powerful tool that we think can bring some alignment. There are also some challenges that come along with it because you may or may not have a seller who's really keen on seeing a lot of changes occur inside the business, but in the right environment or the right kind of partnership piece there, keeping on that existing seller that might be looking to transition out over time, or that's looking to take a second bite of the apple, can be a pretty powerful tool as well, especially if they see the case for the upside and what the buyer is potentially going to do with that business post close. That really, whenever we're coming in from the investor perspective and we can see a lot of alignment between the seller and the buyer, that can give us a lot of quiet confidence that the deal's probably going to be headed in a good direction because the seller has gotten to know that buyer as well, and they feel pretty confident that they're going to be able to continue that legacy on either the same or better, maybe even than what they had, the path that they had it on. So that's another thing that we think will help build alignment between people. And to your point, there's really a million ways you can be creative during the deal structure itself, and every one kind of lends itself to solving a different challenge. But that's the fun part about deal structure, in a way that you can really try and create deals where everybody's getting something that's important to them. And the better each person in the deal can understand what is important to the other party, probably the more likely you are to be able to move to successful negotiation where the selling party's happy, the buyers are happy, the investors are happy. And that's done through thoughtful structuring, I think, more so than just, a lot of times people are overly focused on the headline price. And you know how the old saying goes about you set the price, then I set the terms, or vice versa there. And so it's really important that you are creative with those in order to be able to hopefully make everyone leave that transaction with a good feeling and with the results that they're looking for. And so that's something we're looking for from the beginning.
Yeah, that's great. And there are so many ways you can get creative with deal structures. We've seen some deals that have gotten, structured and engineered to the point that it looks like a $100 million acquisition, but that's just by virtue of some of the folks that are starting to buy businesses, right? Lot more kind of transactional finance acumen coming into the space. When you talk about rollover equity, it's an interesting one when we think about it, and I've given this kind of feedback to searchers every so often, but I'm curious to get your take, has an interesting impact because if there's no clawback features, if it's fully vested at close, and depending on the seller's sort of the cash at close that they receive as well, it can have sort of a mixed outcome, right? It can almost be as like a free path to a second bite at the apple, and they can write it off as something that's just sitting in their extras account. Um, and our sense is, it's not always the case, but if you're giving a seller rollover equity, but they're not planning to stick around and bring the business to that second kind of event, then there's not as much drive to see the value of that rolled equity. But if you've got a seller, and maybe if you've structured the equity in a way that it's most valuable if there's an event, so there's maybe clawback features or there's some type of performance vesting, something like that, especially if the seller's plan is to stick with the business and drive growth into another outcome, then it can be very effective, right? So curious to hear how you've seen rollover equity used best.
Yeah, I think that the mantra of one size does not fit all is pretty important there, because depending on where the seller is and kind of what they're in a life cycle, if they may or may not have a lot of incentive to help or participate post close. And to your point, if they're getting a check for 80 or 90% of the proceeds for that company, it may not be a huge motivator for them to necessarily perform post close. But I think that's where understanding the situation of the seller, where they're at, probably in career life cycle, and what they're hoping for in the business. And that should be something that is kind of fleshed out, hopefully earlier on in the process, before you're kind of sitting there negotiating final terms and maybe consulting agreements and things like that. There should be some understanding of what the goals are for that seller. In some cases, sellers are pretty upfront about the fact that they're looking to take a step back, but not all the way out. And that can be a good fit. But then you've got another set of dynamics that come into play where you got to navigate that old seller still being involved in the business. And that may be confusing for some of the employees that are staying on, or you may run into places where there's, that the employees don't know who to report to. Do I still talk to the old owner? Am I dealing with the new owner? And so it can kind of create its own set of issues that have to be monitored. But I think that's where, as in most things, communication can really solve a lot of that up front, and making sure I would always advise that people are pretty wary of who they get into business with, especially whenever they're taking rollover equity and they're going to be married to that person for a long time. And so even though they might be a minority investor, it's pretty important to make sure that there's alignment there for objectives and what the goals are for the company, who's going to play what role, and have very good, clearly defined definitions into a situation like that before they go into it. And I think in the right circumstances, it can be a positive. It can also be a definite negative or a distraction for running the business if it's not managed in the proper way and if everybody's not really clear. And I think that sometimes people are a little nervous about defining what those roles might be post-close because they're scared of messing up a transaction. But I think that's far more important to get that clarity early on in the process. And if a transaction's not meant to be, then everybody can walk away. And that's a lot better situation than getting into a transaction, there being misunderstandings about what everyone thought their roles and responsibilities were going to be, and then you're kind of stuck in that post close. And so I think that being thoughtful and communicating on both sides up front, and that don't try and force fit it if it's just not a good place for there to be an equity carry, then don't do that. That's one of the nice things about being in this space, is that we've got a lot of flexibility with how to structure deals. We've got multiple different paths to be able to pursue them between equity investors and funds such as you and I have. We've got the group of banks that are willing to provide debt on these, which might be SBA in smaller deals or more conventional debt. You've just got a lot of different creativity and different mechanisms you can use in order to put the deal together. So you want to take advantage of all that whenever you're structuring the deal, and hopefully stay away from some of the pitfalls, especially if you know that they're out there.
It's a great point. You should ideally get a lot of this, figured out and have a good sense of the seller's goals earlier on in the transaction so you can put that structure together in the LOI, right? And have it kind of baked at that point. One thing we look really close at that we haven't brought up yet is key person risk. And one lens to kind of look through that, just like we looked at customer concentration, is the deal structure itself, right? So if there's the way we look at key person risk up and down the organization. So there's, of course, the seller is going to often have a lot of relationships. They're going to have processes that may be hidden somewhere in a vault, or they're going to have all the know-how, that sort of stuff. But you can also have sales folks that hold a lot of the key relationships, and you can have GMs that know all the processes and having written SOPs, things like that. So with a seller, you can mitigate some of that risk with contingent consideration, like we've talked about. It gets a little harder when you go down the org chart, especially because the things that are commonplace, like non-competes for seller, which are enforceable generally if it's part of a transaction, become more challenging to put in place for folks like, salespeople that might just be rock star relationship folks. So when you think about key person risk, how do you guys look for that, and how do you advise folks to mitigate it? Similar to the customer concentration conversation.
Yeah, I think that's something that as you understand and you begin to peel back the layers of the onion of how the business works and how it generates revenue, it should hopefully become kind of clear where that revenue comes from, because you're trying to follow a transaction all the way through from its beginning, like whether somebody picks up a call, puts in an email, how does that flow happen from the very beginning all the way through fulfillment of that product or service. And so hopefully throughout that evaluation process, you're going to identify who those key relationships might be. And to your point, it's not always exactly who you think it is. You might automatically think of the seller in that case, but salespeople and others that are in key, maybe account manager, inside folks might be really key too. So I think that that should become apparent through the process as you understand how the sales process works from the beginning all the way through fulfillment. And then I think that that's where a thoughtful buyer should have a plan for retention and how they're going to address those needs post close, because what worked in the past may or may not be effective in the future. I mean, we've all seen circumstances where a business changes hands and the very next day it's kind of like, give me a raise or else I'm going to quit. Or, hey, I'm going to leave and I don't want to work for you. I'm going to go be a competitor, and are going to go out and start something that's out there against them. They're all very key people. And so you don't want those surprises to happen post close. And so a lot of times the way that we'll look at mitigating that might be through the compensation program. And you want to have a good plan for what that's going to be. You might have employment contracts in certain cases, or taking a look at what the compensation plans look like. A lot of times, whenever we look at that from a business, and by the way, I think HR diligence is something that a lot of people tend to skip. They don't want to spend time or money on it, but I think that it's a key area that everybody needs to look at in their buy process. And if you find out that that business is materially underpaying employees, or that they don't really have the benefits package or things that are commensurate with that industry, you're really stepping into a big trap, no different than if you had a lot of vehicles that were, near the end of their life, or equipment, machinery that needed to be replaced. This kind of hidden below the surface iceberg level problem of compensation that's going to come up that you're going to need to deal with pretty quickly. And so I think one, doing that as part of your diligence process if you're a buyer, and also obviously us from the investor side, and then trying to figure out how you're going to address that going forward, because we want all of the team members to be aligned on what the objectives are going to be for the company going forward. And so that might require a little bit of a revamp of pay policies. Maybe the seller was just paying people straight hourly, or there was no sort of profit sharing, or no incentive plan that was in place to make sure that there was performance. And so that's probably something that's going to want to be looked at as part of the transformation plans, as well as how do you make sure that you retain the core people that are there and that are valuable, but also how do you incentivize the entire workforce to be able to want to accomplish the objectives that that buyer has, and that's going to make that organization continue to grow to the next level. Because you're buying this company with its customers and its suppliers and its employees, you really want to preserve that base. And so kind of the first thing that we're looking at in an acquisition is do no harm. Can you come in? Can you keep what's fundamentally strong and sound about that business, what you're paying for, intact? And if you can't answer in the affirmative for that, then kind of none of the other stuff around growth patterns and all that other stuff matters, because you're really paying millions of dollars for something that you want to make sure you can preserve that viable core of. And if you don't have a plan to do that, then that's definitely a questionable investment you're making.
That's a great way to put it. The HR diligence piece is a really strong call out, I think, for investors as well. Of course, it's important for buyers to be looking into that, but investors need to be asking the question, can you send me an employee census, right? What has turnover been? I mean, that's commonplace in lower middle market PE. Employee census, that's kind of table stakes stuff. And I've been pretty surprised how rarely that level of information is available. Of course, it's just not tracked, and they don't have Gusto in place or some kind of
Yeah.
system that tracks everything, but it's as best as buyers can and as best as investors can. It's good to try and reconstruct some of that to get a picture of, have people retained employees, have people retained kind of line managers, key managers, but also, field techs and folks that are going to be doing the work. Because to your point, if they've been getting below market wages, it's going to come out eventually, and that's going to be your bag to hold.
Yeah, even if you get a list of hire dates and current compensation, you're probably going to be able to sense check that pretty closely. If this business has been around for 20 years and all of their employees were hired in the last, 12 to 24 months, that's probably a warning signal that is going to jump out at you to say, hey, what happened? In some cases it may be associated with growth or other things, but you would expect to have some tenured employees. And if you don't, there's probably something that's going on there, whether it's a compensation issue, a culture issue, something that probably needs to be uncovered with that seller that might be material to your transaction. And so little things like that, that as you begin to peel back the layers, it should stick out at you, and you'd want to get answers to the questions. There may be great answers, but you definitely want to ask all the questions so that you can get really comfortable behind the drivers of that kind of behavior from the employee base, I think.
Yeah. We've also seen the opposite be true. We've seen, and this is another question we ask in the same vein, is, are compensation plans intended to stay the same, or will any incentive structures change? And we have, a handful of questions similar to that we typically ask, with the goal of unearthing, is anyone in the organization getting paid well above market, or do they have a bonus structure that's not sustainable, or that, we don't know about and isn't intended to continue? Another one that's key is anyone else in the business besides the seller getting some sort of unpapered transaction bonus? All these types of things can come up if you don't ask about them. And then again, you're kind of stuck with this strange retooling of incentives post-close that can be pretty demotivating for folks that historically have worked in a different way for a different compensation plan.
Yeah, that's definitely true. And I think you can see that a lot. I see it a lot in sales positions where they've got really strong sales performers inside the organization. And whenever you look at the way that the compensation plan was drafted, it might have worked really well for that organization at the time that they put it together. But whenever you start to look at what does that company look like or that compensation program look like at two, three, 4x the size of what they are now, it starts to break down and maybe not be as sustainable of a model. And so figuring out how to address those issues without, kind of getting the poor bad relationships with the existing employees and the team members there that have helped to make it what it is. It's a delicate balancing act, and so you have to be really thoughtful about how any changes you put into place around people's money, they're definitely going to notice and they're definitely going to be very wary of, especially whenever you're a new buyer and you're coming into that organization. They're going to be looking at you with a little bit of distrust automatically. So, making sure that you're thoughtful about the way that you approach those scenarios and the timing of it and how it's implemented, can be the difference between a good rollout and an absolute disaster that really sets you back months, if not years, in the plan.
Yeah. Well, maybe one last topic on this front. Jacob, how do you go about trying to diligence or just understand a company's culture and whether or not kind of the searcher, the buyer is going to be inheriting a productive and kind of growth minded culture or one that might be a little tougher to get moving?
Yeah, I think that a lot of those things are earned from experience of whereas you ask questions, you hear little tidbits that in isolation probably don't mean a lot, but that might ask you to drill down and ask those questions a little bit further. So I'd say I'm listening for those clues as I'm talking with the buyer, since most of the time we're not interacting directly with the seller. We're interacting by means of the buyer in most of those cases. And so as you hear, they might have less experience in this transaction space than what we see over and over and over from being involved in those deals. So as we start to spot things that might require scratching on a little bit more in order to uncover, those are the types of questions that we will immediately want to ask that buyer in order to understand it. But some of the things that we can do from the outside to understand that company culture, you can go and read reviews for an organization. You can look at, they might be BBB member, they might have Google reviews, they might have different ways that you can read about the organization. You might be able to go to Indeed.com or other places where they've sourced hiring from, and you're going to begin to learn, not that all of those reviews are necessarily going to be 100% accurate, but you will begin to get a picture painted for you of what that organization looks like from the inside. And you'll have people making comments. And so if you begin to see multiple things about say a toxic work environment or about a specific leader internal in that organization or about practices that they have in dealing with customers, those are all things that are going to raise a red flag and make you want to investigate further. Because if you find out they have a horrible reputation with their customers or with their employees, or they're dishonest, those are all things that should give you pause about proceeding with a transaction. Because if they've dealt that way with their employees and with their customers over the years, you shouldn't be naive enough to think that you as the buyer are going to get a different version of that person. You're going to get the same version except maybe in a little bit nicer packaging. And so they're going to be trying to put their best foot forward. But sometimes going to some of those outside unfiltered sources can help you to, not necessarily that any of those things is going to be a deal killer, but you'll want to understand the drivers and take the totality of the circumstances into account to see, is there more here or is it an isolated incident? Because sometimes that'll tell you a lot more than, the seller's always going to be trying to put their best foot forward. And so you want to try and find some alternate views for that. As a buyer, whenever you start to get engaged, hopefully you're able to talk to some key personnel before the transaction. And I would encourage that. I mean, you should take the opportunity to ask a lot of open-ended questions and get the other side talking, because that's an opportunity for you to take some notes and things of behaviors or activities that you might want to be on guard for as you're evaluating the transaction in general.
That's great. Those are some great topics and good wisdom for anyone that's considering investing or looking to learn more about investing in this space. Jacob, thanks so much for joining us. Any kind of closing remarks or how people can get in touch with you? Or?
Yeah, it'd be great. So I'm on LinkedIn. Everybody's welcome to reach out to me there. Also, the fund is on LinkedIn as well, or you can go to the website. It's Condo Capital, Kando Capital, Capital.com. And feel free to reach out to us there, both buyers, investors, anybody who'd like to talk more about the space. I love the small business space, as do you, I know, and could definitely talk about this and transactions all day long. So happy to talk to folks if they're in the space, either as an investor or as a business buyer, and they want to reach out. I'd be happy to talk to them as well.
Thanks so much, Jacob.
All right, great. Thanks, Sean. Appreciate you having us on.